This is question number 7 of the quiz 5 for chapter 5. So here you are provided with a graph. So horizontal axis here is quantity of bonds, and the vertical axis here is the price of bonds. So from that we can tell it's about the asset market framework, which determines the equilibrium interest rate or equilibrium bond price. And from that, we can determine the equilibrium interest rate. So you can see that B1, B subscript 1, superscript S, that's the supply curve, and B subscript 2 and superscript S, that's the new supply curve. So B1 is the old supply curve. And the same is for the demand curve, which is downward sloping. So from B1 to B2 here. So from this chart, you can see that the supply curve shifts to the right and demand curve actually shifts to the left. So the question asks you, in the figure above, the price of bonds would fall from P1 to P2 because this is the intersection of the old demand and the supply curve, that's the P1, and this is the intersection of the old supply and the demand curve, and that's the P2. So the question asks you which mechanism can make this happen, shifting the equilibrium bond price from P1 to P2, basically. So A, inflation is expected to increase in the future. So if the inflation is increasing, expected increase in the future, we talk about that in our this session, and you can also check my lecture slides. If the in the asset market framework, the expected inflation, where if the expected inflation increases by Fisher equation, if we go back to the Fisher equation, you can see that if you increase the expected inflation, and the nominal interest rate generally doesn't change overnight, right? Because that's basically determined by the price. But if you increase this, then with this fixed, the real interest rate will have to be decreased in order to balance this equation, right? So if the real interest rate is decreased, then from the demand perspective, bondholders get a lower return. Hence, the demand for the bonds will be decreased. And that seems to be the case here. And if you decrease the decrease the real interest rate from the borrower's perspective, and that's from the bond suppliers perspective, their borrowing cost will decrease. Hence, they have stronger incentive to issue more bonds, and that will shift the supply curve to the right. And that's exactly what's shown in this graph. Hence, actually, without the need to go to the other choices, we can just choose A. But of course, if you want, you can also look at the other choices. B, interest rates are expected to fall in the future. So if interest rates are falling in the future, actually that's exactly the opposite, because the bond price is expected to go down, and we know the price and interest rate have an inverse relationship. Hence, the interest rate actually is expected to rise in the future. And C, the expected return on bonds relative to other assets is expected to increase in the future. So if this happens, expected return on the bonds relative to other assets, that's very important, is expected to increase in the future. That means the demand for the bonds will increase, and that's not what happens here. Right? Demand is actually going down, so this cannot be true. And finally, D, the riskiness of bonds falls relative to other assets. If the riskiness of bonds falls, then investors find the bonds to be more attractive, right? Because now it becomes less risky if you hold the return. Hence, they will have stronger incentive to buy the bonds. Hence, the demand for the bonds has to shift to the right. But that's not what happens. Hence, checking the other three choices, we still confirmed that A is the only correct choice. So now let's check our answer. The input is correct.